you look at the stock market, it might seem simple: buyers, sellers, prices moving up and down. But behind the scenes, there's a hidden world most people never see. A world where computers dominate, trading faster than any human could, executing thousands of trades in milliseconds. This is high-frequency trading, or HFT, and it has completely changed modern markets. High-frequency trading uses algorithms, computer programs designed to analyze market data and execute trades automatically. These algorithms react to price changes, patterns, and even news in microseconds. To give perspective, a human blink takes about 300,000 microseconds. HFT systems act faster than that. That speed gives them a massive advantage, allowing them to profit from market movements no human could detect. The goal of HFT isn't long-term investing. These systems aren't holding stocks for years or waiting for dividends. Instead, they exploit tiny inefficiencies in the market, small gaps in pricing, brief delays, or predictable patterns only computers can detect. Even a fraction of a cent per share can generate millions when multiplied across thousands or millions of trades. For example, an HFT system might buy a stock at $100.001 and sell it at $100.002 across a million shares, turning micro movements into massive profit. HFT firms invest heavily in technology. They build ultra-fast servers, co-locate them near exchange servers to reduce latency, and design highly efficient algorithms. Every microsecond counts. Some firms spend millions just to shave off a few microseconds of delay. In HFT, speed is literally money, and milliseconds can make the difference between profit and loss. There are different strategies in high-frequency trading. Market making is common, buying and selling the same asset at slightly different prices, profiting from the tiny spread between the bid and ask. Statistical arbitrage identifies correlations between assets to exploit small price differences before anyone else. Some advanced systems even react to news articles in real time, analyzing headlines with AI and executing trades faster than a human could even read them. Imagine an algorithm reading a company's earnings report and acting before any human has clicked buy. High-frequency trading is controversial. Critics argue it gives unfair advantages to firms with the fastest systems, making it nearly impossible for retail investors to compete. Algorithms can detect trends, front-run orders, and profit from tiny market inefficiencies invisible to humans. On the other hand, proponents argue HFT increases liquidity, making it easier to buy or sell assets quickly and stabilizing certain market conditions. But HFT can also create instability. The flash crash of May 6, 2010 is a famous example. In minutes, the Dow Jones dropped almost 1,000 points, around 9%, and then quickly recovered. Algorithmic trading amplified the sell-off, creating panic that no human could have predicted or controlled. Events like this show both the power and the risk of high-frequency trading. Retail investors might think HFT doesn't affect them, but it does. The prices you see, the spreads you pay, and the speed of trade execution are all influenced by HFT. Even long-term investors should understand that modern markets are driven by machines, data, and speed, not just human decisions. Real-world examples illustrate the gap between HFT and ordinary investors. Imagine two traders. One reacts manually to news, buying a stock based on a press release. The other uses HFT algorithms. While the human reacts in seconds, the algorithm executes thousands of trades in milliseconds, profiting from tiny price differences that the human cannot even see. Over time, these small advantages compound into massive profits for firms using HFT, while traditional traders are left behind. HFT is not limited to stocks. Crypto, commodities, and futures markets also experience high-frequency trading. Algorithms exploit price differences across exchanges, detect patterns, and execute trades faster than human eyes can follow. The principles are the same: speed, precision, and exploiting micro inefficiencies. Despite its complexity, HFT teaches one key lesson: modern markets are no longer purely human. Decisions are influenced by machines, algorithms, and data at speeds invisible to most people. Success today requires understanding not only assets and fundamentals, but also the technology and systems shaping the market itself. Retail investors don't need to compete directly with HFT firms to succeed. The goal is to understand the environment they operate in. Long-term investing, diversification, and patience remain powerful strategies. HFT may dominate short-term trading, but informed investors can still thrive over months and years by focusing on fundamentals. If this story helped you understand how high-frequency trading really works, take a moment to subscribe to the channel. More deep dives into hidden market systems, algorithmic trading, and investing strategies are coming. And you won't want to miss what happens next. Knowledge, awareness, and preparation are your first steps toward navigating a market where machines make moves faster than any human could.